We all hear that behind every great investment, there's a great business. But what does great even mean? We often think of profits or growth or a product everyone loves. But here's the thing. Those answers can be a real trap. Sometimes the companies that look the best on the surface are actually the worst places to put your money.
And that right there is the big puzzle we're going to tackle in this explainer. How is it possible that a company can be making tons of money, look totally successful, but end up being just a terrible stock to own? It's a paradox that trips up even seasoned investors all the time.
Well, the answer really lies in this one crucial distinction. A good company and a good stock are not the same thing. And the key that unlocks this puzzle, the metric that helps us tell the difference, is something called return on invested capital, or ROIC for short.
Okay, so let's dive in. What exactly is this ROIC and why is it so incredibly powerful? Well, you can think of it as the ultimate scorecard for any business.
At its heart, ROIC answers a really simple question. For every single dollar a company has sunk into its business, building factories, developing software, all of it, how much cash profit does it spit back out each year? It's the true measure of how efficient and profitable a business really is.
And look, the whole idea is super intuitive, right? It's that old saying, you have to spend money to make money. ROIC is just the tool that puts some hard numbers to that idea. It systematically compares the money a company spends to the profit it actually makes.
The formula itself is pretty straightforward. First, you figure out how much the company made from its main business after taxes. It's a clean profit number called NOPAT. Then you look at how much the company had to spend over all the years to build up the business that makes those profits. That's its invested capital. The return is simply the profit divided by the investment. Easy enough.
But just getting a number for ROIC, that's not the whole story. I mean, a 10% return might sound pretty good, but is it really? To know for sure, we have to compare it against something. We need to put it to the test. And that test is all about comparing what a company earns, its ROIC, with what its capital actually costs. This cost has a fancy name, the weighted average cost of capital, or WACC. But just think of it like this. If you borrow money from the bank at 5% interest, you have to earn more than 5% on your investment just to break even, right? For a company, WACC is that break-even point. It's the hurdle it has to clear.
So this brings us to the golden rule. It's simple. If a company's ROIC is higher than its WACC, it's actually creating real economic value. But, and this is huge, if its ROIC is below its WACC, it is literally destroying value with every dollar it invests, even if it looks profitable on the surface. And get this, this isn't just some textbook theory. You can literally see it right here on this chart. It plots how much a company earns over its cost of capital against its valuation in the stock market. And look at that. It's a clear upward trend. The market absolutely gets this. It gives higher valuations to companies that earn more than their capital costs. The data proves it.
Okay, so we've established it. A high ROIC means you've found a great business. But hold on. Remember our original puzzle? A good company isn't always a good stock. And here comes the twist. The market, it's not dumb. It already knows which companies have a high ROIC.
That high ROIC is already priced into the stock. You don't get rich by buying what everybody already agrees is great. The real money, the truly massive returns, come from correctly anticipating a change. It's all about finding companies the market thinks are just okay, but are actually on the verge of becoming great. Or, just as important, avoiding the great companies that are about to stumble.
Okay, now you really need to pay attention to this table because this is where it all clicks. This shows you the stock returns for companies based on where their ROIC started and where it ended up 3 years later. Now just look at the corners. If a company starts out as one of the best but falls to the worst, investors lost 11% a year. But what about a company that starts at the bottom and manages to climb all the way to the top? A 33% annualized return. I mean, just let that sink in. That is the incredible power of improving business quality. Going from a so-so business to a truly great one generated the best returns in this whole study, way better than just owning a company that was already great to begin with. And now for the flip side, the danger zone. A company that was once a superstar, a top-tier business, that let its quality slip all the way to the bottom. Well, its investors got hammered, losing 11% every year. The message here could not be clearer. When it comes to your investments, it's not about where ROIC is,
It's about where it's going. All right, so if we know that an improving ROIC is the name of the game, that leads to the obvious next question. How do companies actually do it? What are the strategic moves they can make to get that number up?
Well, you can break ROIC down into two main drivers. It really just boils down to profitability, how much profit you squeeze out of each dollar in sales, and capital efficiency, which is how many dollars in sales you can generate from every dollar you've invested in the business.
And this chart just lays it out perfectly. It shows there are two classic ways to win this game. Down in the bottom right, you've got companies with crazy high profit margins. They don't have to sell a ton of stuff, they just make a lot on each sale. Think of a luxury brand. Then, up in the top left, you've got companies with razor-thin margins, but they are unbelievably efficient. They turn over their capital like crazy. Think of a big discount retailer. Two totally different strategies, but both can lead to a fantastic ROIC.
So let's bring this all home. What are the big takeaways? First, ROIC is your best tool for measuring true business quality. Second, a company is only creating value if that return is higher than its cost of capital. It's whack. Third, and this is the big one for us as investors, it's the change in ROIC that really drives stock prices, not how high it is today. And finally, companies get there by either boosting their profits or becoming way more efficient.
And all of this leaves us with one final critical question. As an investor, your job isn't really to find the companies that everyone already knows are great. The market's already figured that out. The real challenge, the place where you find those incredible returns, is in figuring out which company is going to improve its ROIC tomorrow. That is the billion-dollar question.